In previous episodes where silver began signaling strain, the pattern was never an immediate collapse or an instant repricing to some true value. Instead, the system entered a phase of prolonged tension, one where official mechanisms worked harder to maintain order while unofficial behavior quietly adapted underneath. That tension is where we are now. At this stage, price becomes a poor guide, not because it's meaningless, but because it's being asked to do too much. Price is expected to reflect scarcity, sentiment, risk, and confidence all at once, while the system actively tries to mute one of those variables. The result is contradiction, volatility without resolution, movement without clarity. This is the phase that tests participants psychologically more than financially, because it forces a choice, not a binary one, but a directional one. Do you continue operating as if access will normalize automatically? Or do you begin adjusting behavior in anticipation that it might not? That decision doesn't happen all at once. It happens incrementally. Small changes in allocation, slight shifts in preference, quiet rebalancing away from promises and toward possession. Individually, these actions look insignificant. Collectively, they change the market. One of the most important dynamics during this phase is relative performance. Silver does not move in isolation. It exists in relationship to other stores of value, particularly gold. When confidence is high, gold tends to dominate as a conservative hedge, while silver lags due to its industrial exposure and volatility. But when stress intensifies, silver often begins to outperform. Not because it's safer, but because it's more sensitive. That sensitivity turns silver into an accelerant. When participants decide they want exposure to tangibility but cannot access or afford larger allocations elsewhere, silver becomes the pressure valve. It absorbs demand quickly, and because its market is smaller, price and availability respond faster. This relative shift is a signal not of speculation, but of urgency. Another dynamic that becomes critical here is supply elasticity. Unlike assets that can be issued or expanded rapidly, silver production responds slowly to price signals. Most silver is produced as a byproduct of other mining operations, which means output decisions are driven by different economics. Even significant price increases do not result in immediate supply relief. That rigidity matters. When demand rises into an inelastic supply environment, price is forced to carry the burden of adjustment. But if price is partially constrained by structural mechanisms, the adjustment shows up elsewhere in availability, premiums, delivery terms, and behavior. This is why stress becomes visible in fragments rather than headlines. You might see delays here, rationing there, uneven pricing across regions, or sudden shifts in sourcing patterns. None of these alone confirm a crisis. Together, they suggest the system is adapting under pressure. This adaptation phase is often misunderstood as stability. Observers see that markets haven't broken and assume the risk has passed. In reality, the system may simply be transitioning into a new operating mode, one where friction is normalized and access is conditional. That normalization of friction is one of the most important shifts to watch. When friction becomes expected, participants stop assuming smooth execution. They start planning around constraints, and planning around constraints reinforces those constraints because it changes behavior. This feedback loop is subtle but powerful. Another factor that amplifies this loop is uncertainty around future policy responses. When market participants cannot clearly anticipate how authorities will respond to continued stress, whether through rule changes, messaging shifts, or direct intervention, they hedge by reducing dependence on those responses. In practical terms, that means fewer assumptions and more optionality. Optionality has value, and in markets like silver, optionality often takes the form of physical access. Not because participants expect immediate failure, but because they want flexibility if conditions worsen. This is how precautionary behavior scales into market impact. It's also why the absence of dramatic headlines should not be reassuring. The most significant reallocations rarely happen during peak attention. They happen quietly, gradually, while narratives are still catching up. History shows that once this phase begins, the system faces a narrowing set of choices. Either confidence is restored through consistency and transparency, or behavior continues to adapt around uncertainty. Restoring confidence is difficult because it requires more than words. It requires sustained alignment between promises and outcomes, between quoted prices and actual access, between expectations and experience. If that alignment holds long enough, stress fades. If it doesn't, the market moves into a different regime. In that regime, assets stop being evaluated purely on return potential and start being evaluated on reliability. Liquidity becomes secondary to certainty. Convenience becomes secondary to control. This shift does not happen overnight. It unfolds through moments of frustration, missed opportunities, unexpected delays, small disappointments that accumulate into changed expectations. Silver's role in this process is not to predict outcomes, but to reveal the transition. When silver behaves like a commodity, the system is functioning normally. When it behaves like a monetary signal, the system is adjusting. And when it behaves like insurance, the system is under stress. Which behavior dominates next will depend on how the current phase resolves. If access widens and premiums compress naturally, confidence will recover. If access remains uneven and explanations remain vague, behavior will continue to adapt defensively. Neither outcome requires catastrophe. Both require attention. Because the most dangerous assumption at this point is that markets will simply revert to prior norms without cost. Every period of stress leaves residue. It changes baselines. It recalibrates expectations. Participants who recognize that early can adjust gradually. Those who don't are forced to adjust suddenly. What comes next is not about timing a move or predicting a spike. It's about understanding the scenarios the system is now exploring and what signals would indicate a shift from one to another. Those signals won't come from headlines. They'll come from behavior, how access evolves, how institutions respond, and how participants reposition as uncertainty persists. That's the lens needed now. At this point, the market is no longer asking whether something unusual is happening. It's asking how persistent that change might be and what it implies for behavior going forward. When stress lasts long enough to alter expectations, the system stops reacting tactically and starts adjusting structurally. That's the phase where outcomes begin to diverge not dramatically at first, but meaningfully. From here, there are a limited number of ways this can resolve, and none of them depend on a single announcement or a single price move. They depend on whether confidence can be rebuilt through consistent experience. One possible resolution is gradual normalization. In this scenario, access improves quietly. Supply chains loosen. Availability becomes more predictable. Premiums compress over time rather than collapsing suddenly. Paper and physical markets realign without fanfare. To the outside observer, it looks like the episode simply fades. But even this soft outcome leaves a lasting imprint. Participants remember how quickly access tightened and how little notice they received. They remember that assumptions they once treated as safe defaults turned out to be conditional. That memory changes future behavior. The next time stress appears, even at a smaller scale, responses will be faster and more defensive. Another resolution is managed instability. This is where the system functions but never quite relaxes. Friction becomes normal. Availability exists, but with limits. Pricing fluctuates within wide bands. Adjustments are frequent and reactive rather than decisive. Nothing breaks, but nothing fully settles either. In this environment, silver behaves erratically. Rallies stall. Pullbacks fail to restore confidence. Each move is met with skepticism. The market oscillates between relief and concern, keeping participants engaged but uneasy. This outcome is challenging because it rewards neither complacency nor urgency. It demands patience but punishes passivity. The third resolution is escalation not in the sense of immediate crisis, but in persistence. If access remains inconsistent and explanations remain opaque, behavior continues to adapt around uncertainty. Participants begin to assume friction rather than treat it as temporary. They plan for delays. They value control over convenience. They reduce reliance on systems that feel fragile. In that environment, silver stops being treated primarily as a trade and starts being treated as insurance. Price becomes less important than availability. replacement risk becomes more important than short-term volatility. Traditional valuation frameworks lose influence because the asset is being evaluated for a different purpose. This is where fragmentation becomes visible. Markets that once moved in unison begin to drift apart. Prices differ across regions. Products behave differently. Access depends on relationships rather than screens. None of this looks dramatic in isolation, but together it signals a shift in how the market operates. What's important to understand is that these outcomes are not mutually exclusive. The system can move through all of them over time. It can normalize briefly, then slip back into instability. It can escalate in one area while stabilizing in another. Markets are not linear. That's why the most valuable skill in this phase is not prediction, it's recognition. Recognition of what the market is prioritizing. Recognition of how participants are behaving rather than what they're saying. Recognition of whether confidence is being restored through experience or merely defended through language. Price alone will not answer those questions. Behavior will. Are participants comfortable delaying decisions, or are they accelerating them? Is availability improving smoothly or in fits and starts? Are institutions communicating clearly or relying on generic explanations? Are participants treating volatility as opportunity or as confirmation of risk? These signals matter more than any single number. Because silver, in this context, is not the destination, it's the diagnostic tool. It reflects how trust is being allocated across the system. When trust is high, abstraction works. When trust weakens, tangibility gains value. When trust is questioned broadly, behavior shifts decisively. If trust were intact, access would not become conditional. If confidence were strong, alignment between paper and physical would not strain. The fact that these dynamics are present tells you the system is recalibrating, even if it hasn't fully acknowledged it yet. Recalibration doesn't imply collapse. It implies change. And change forces choices. Not necessarily dramatic ones, but directional ones. Choices about where to reduce assumptions, where to increase optionality, where to accept friction in exchange for certainty. There is no single correct response because participants have different constraints and objectives. But there is a common mistake, assuming that nothing fundamental has changed simply because markets are still functioning. Markets can function under stress for a long time. What changes is how they function. Those who recognize that early can adjust incrementally. They can remain flexible. They can avoid being forced into decisions by sudden shifts. Those who don't often find themselves reacting late when options are fewer and costs are higher. Silver's current behavior is one of those early signals, not because it guarantees a specific outcome, but because it highlights where assumptions are being tested, where alignment is being strained, where confidence is no longer automatic. Whether this resolves into normalization, managed instability, or a more persistent recalibration will depend on how consistently access and transparency improve from here. Not on reassurances, not on commentary, on experience. That's the standard markets ultimately use. If you've stayed with this analysis through to the end, you already understand that this isn't about chasing a spike or calling a top. It's about observing how systems behave when pressure builds and deciding how much reliance you're willing to place on assumptions that may no longer hold. If you want more analysis like this focused on structure, incentives, and behavior rather than hype, make sure you're subscribed. And let me know in the comments which path you think the market is moving toward right now. Normalization, managed instability, or escalation.